webinar, which is the second in a series of 4 webinars on building resilience through climate risk insurance for MSMEs. This series of webinars replaces a regional workshop that we had organized to hold in the Philippines for these 2 days, and we're very pleased that in very active collaboration with MEFIN and GIZ's RFPI program and Pioneer, we've been able to accommodate an adaptation to the current events that are keeping so many of us in lockdown to organize this series of webinars. My name is Katharine Pulvermacher. I am the Executive Director of Microinsurance Network. And I'd like to welcome you all this morning. We now have a number of the participants who've joined, so I think if we can just move on to a little bit of housekeeping before I introduce our panelists. So today's webinar is scheduled to last 1 hour, including questions and answers. We'll first hear from Claire Souch, and then from Stefan Eppert, and you can ask questions using the Q&A feature on your screens. So please do use that, because to ensure a good quality of experience, all participants will be muted. Also, please note that slides and a recording of this presentation will be circulated later, and any questions that are left unanswered, we will endeavor to answer via email. If you have any technical issues, please message the Microinsurance Network by using the chat function so that they can help you out. Okay, we have 2 of our team on standby for technical issues. Thank you very much. So without further ado, I'd very much like to welcome Claire Souch, who is an independent consultant and advisor to the IDF, and who has 20 years of experience in catastrophe risk modeling, gained for the global reinsurance and insurance industry, covering both property and agriculture lines at very senior levels. Claire is currently advising on many aspects of catastrophe risk modeling, uncertainty, climate change, and risk financing across the public and private sectors. And she is an advisor to the Insurance Development Forum and OASIS LMF open source loss modeling platform. Claire has held previous positions as Head of R&D and Products at KatRisk, Head of Catastrophe Model Development and Evaluation at SCORE, and was Senior Vice President of Global Model Management and Strategy at RMS. Claire, we're very grateful to have your insights this morning, and could I ask you to take over and start telling us about the issues surrounding data?
Thank you. Good morning, and thank you very much, Katharine. We'll just bring up my slides now. So yes, good morning to everybody, and thank you for joining on this remote webinar. I'm going to spend about 20 minutes or so giving an overview, a high-level overview, firstly of the Insurance Development Forum. I'm going to be talking about climate risk insurance and data and the modelling required to put in place climate risk insurance mechanisms. And I'll talk to you about the work we're particularly focused on within the Insurance Development Forum group on risk modelling, about open data and open risk models and the challenges associated with that, and hopefully some proposals of how we can overcome those challenges. And then I'll be handing over to our second speaker, Stefan Eppert. So first of all, a very brief introduction to the Insurance Development Forum. This is a public-private partnership bringing together insurance industry, World Bank, the UN, and governments, national, local governments, and other actors who recognize that climate risk insurance is one potential mechanism that can be used for adaptation to climate change. Now, we say that this is one potential mechanism because, of course, there's a whole range of climate change adaptation measures that can be taken. And much of the data and the risk modeling that we do for the risk insurance is also useful for other types of risk adaptation measures. Essentially, what underpins all of this is understanding the risk and the potential impact of climate change. The IDF is specifically aligned with the Insure Resilience Vision 2025 programme, which is to provide climate risk insurance for 500 million more vulnerable people by 2025. And this is a very large intergovernmental programme. And we are supporting the growth and development of financial mechanisms. And importantly as well, along with associated risk management capabilities to help achieve the objectives of the Sustainable Development Goals and related UN agreements made during 2015 and 2016. Now, I'll just give a quick overview of the two main different types of climate risk insurance that exist, insurance mechanisms, because it has relevance for what type of data is required. Now, increasingly, parametric schemes are becoming very, very popular. Now, in parametric scheme, the contract is to agree to make a payment upon the occurrence of a predefined triggering event. So this will be a flood or a windstorm of a specific strength. It could be an earthquake, for example, of course. It enables very fast payments. You don't require any loss adjusters or damage assessment after the event to assess the actual damage or loss. What matters is whether you've had the event of the predefined or pre-agreed intensity measure. And I'll talk about that a little bit on the next slide. However, there is what we call basis risk associated with these products, which means that events can occur which produce significant damage or loss, but there may not be a payout because there's a mismatch, usually because of uncertainty in our understanding or the modeling or the data or something like that, between what we thought would cause damage from an event perspective and actually what actually happened in reality, or vice versa, of course. Now, the more traditional indemnity-based insurance mechanisms, they compensate for actual loss or damage. And so these require independent assessment of the loss or damage after the event. You can get quite complex and long claims assessment processes, particularly when facilities such as large industrial sites are associated, or if there's interruption to business, ports, that type of thing. Claims assessment process can take many months, or in some cases, there's been cases of a year or more. However, you do get this much closer connection between the policy payout and the actual damage and loss incurred. So I'll talk a little bit now about the different data requirements between these two schemes. For parametric schemes, as you might imagine, because the trigger for the payout is when a pre-specified index or parameter is exceeded, usually associated with a triggering event itself, that, as I say, could be an earthquake or a storm or a flood, where the parameter or the index is the magnitude of the earthquake or a certain wind speed has been recorded, or a certain amount of precipitation over a defined length of time could be recorded, and this can go either way. So it could be for flooding, it could be in excess of a certain precipitation, certain amount in 24 hours, or for example for drought, this could be if you actually have not had enough precipitation over a key period of time, for example 2-week period during seed germination. And then there is a pre-agreed payout if that parameter or index threshold is reached or exceeded, regardless of the actual physical loss sustained. So if there's been a category 5 tropical cyclone hitting a defined section of coast, then the payout could be pre-agreed to be a certain amount, for example. Or In this other example, you have a certain amount of money being paid out for every millimetre of cumulative rainfall above a certain threshold. And as I say, that would have to be over a defined period of time. It could be 24 hours or a week or anything like that. So it has to be an objective measure. And any parameter or index that is used as the basis for the solution must be objective. It must be independently verifiable. So often what's used, for example, are the meteorological stations of the National Meteorological Agency, some sort of independent body that's not owned by either party in the transaction. That's quite important, of course. Must be transparent and it must be consistent. And the real criteria here is this need to have the good, independent, robust, real-time data. And that data has really ideally needs to come to close to where the risk is in order to reduce the basis risk. And of course, here we can immediately see one of the challenges, main challenges with this type of mechanism is having that data readily available where the risk actually is that we're interested in. So that could be a farmer's field, or it could be a village or a town, or it could be an industrial site, as I mentioned as some examples. So there's certainly challenges there. Satellite data is used if there are not any on the ground observation sites, but they also come with some challenges around resolution of satellite data, and also the methodologies used to extract weather variables such as rainfall from satellite information can lead to uncertainty and mismatches between those weather variables and what was actually recorded on the ground at a very local site. And these are just a couple of screenshots I took from the Philippines Nationwide Operational Assessment of Hazards websites, and they show here we have the distribution of weather stations and rain gauges. And you see there is a good density of both of them across the country. But when you zoom in on the right-hand side, you can see there are gaps there, particularly in the, I think the blue are the weather stations and the green are the others, but it may be the other way around. But you can see there are some gaps there in where there would be observations being taken, which you'd have to consider in the design of such a program. Now, of course, for insurance mechanisms, we have to be able to price the risk, and that requires understanding risk. And for this, we need to know, on average, what the expected losses, which may be paid out every year, are, as well as the probability of very large losses, so extreme events which may bankrupt the scheme, for example. So both of these types of metrics we need to have an understanding of if we're putting together some sort of insurance scheme mechanism, whether that's parametric or an indemnity-based scheme. One of the main tools that's used for this type of analysis are called catastrophe risk models. Now, these are a specific type of disaster risk models. They've been created and used within the insurance industry for well over 20 years now. And they give a probabilistic estimate of potential losses to a defined set of exposures, that is assets, or people, or whoever it is, whatever it is that you want to insure for a specific peril in a defined area. For example, earthquakes or cyclones hitting the Philippines, or even a specific province within the Philippines. Models are essentially a way of robustly extrapolating from limited data, as I showed on the previous slide, using statistical techniques to simulate all possible events that could affect any given area and their probability of occurring. Now, the data requirements for risk modeling are quite substantial. So we have to understand the hazard. And this is the probability and severity of events happening, whatever the nature of the event that we're concerned about is, for example, cyclone or flooding, or it could be longer duration type of events such as sea level rise or drought, not just the extreme events. Generally, the approach is to use historical data on the frequency and severity of events to estimate the probability of events occurring in specific areas. But increasingly as well, of course, we're using the output of climate models to give future projections. And in fact, even current day projections, because of course, in many parts of the world and for some perils, it's clear that the climate has already changed from history. So taking historical averages is no longer appropriate necessarily for everywhere in the world anymore for certain perils. So we're running some projects now where we're taking output from climate models and applying them to understand both the current risk today and future risk projections on the probability and severity of these types of events. And there are still lots of uncertainties, which I won't go into a lot of detail today, but of course we must recognize that there are still a lot of uncertainties in the climate model projections of the future and of the future influence of climate change on extreme events. We also need to understand the physical environment of the area under consideration. So, for example, its elevation, topography, soil type can have a big influence on, for example, flooding. Land use and land cover can have a big influence, urban areas versus agricultural areas versus forests. The drainage situation, flood defences, they can all influence the hazard experienced at any location. We need to understand the exposure. This is the people, the assets, the buildings, the infrastructure, anything that may be affected and anything that there is interest in providing risk insurance schemes for. And we need to understand where they are, what are their characteristics, and what's their value. So these can be crops, they can be people, it can be people's livelihoods, as well as physical structures and the cost to repair or rebuild those physical structures. And of course, we need to understand the vulnerability of that exposure. So the impact, the damage, the loss caused by the event to those assets or to those people or to those livelihoods. And then we can understand, and we need to understand what damage and loss, or try and project what damage or loss will be caused by different events of different severities. It's usually expressed as a percentage of the total value at risk. And again, here we are often reliant on a mix of some historical data, if there have been surveys after severe catastrophic events or after major droughts or floods, for example, where this type of data has been collected in the field. And that can be physical measurements, or it can be surveys, particularly where we're interested in people and the impact on their livelihoods. But again, it's generally very limited type of data. So this is again an area where working with academics and researchers is important to try and get these vulnerability estimates as accurate as possible. So the key challenges, I think, are probably quite obvious. The data availability being the primary one, so the quantity, as well as the quality of the data, the length of historical record, the density of the observation networks, the availability of the geophysical data, especially at local levels, especially talking about or thinking about microinsurance programs where we do really need quite localized data to understand the local situation. Now, even if data is available, there can be issues around access to the data. and openness. Of course, there are concerns about sensitivity of data in lots of these cases, and there are also genuine concerns about profiteering from data that may be publicly funded or publicly collected. And thirdly, I would say another challenge is that we've seen in the Insurance Development Forum is that we have seen in some cases, there are multiple repetitive and redundant efforts going on to producing risk and analyses, which are quite static, and they just give a snapshot of the risk at a single point of time, without making the models underlying those analyses available to others to be updated and used on an ongoing basis. And Stefan will talk a little bit more about this as well. But it's also a challenge because these static risk analyses, which are often delivered as reports, as I say, just reflect a single snapshot in time. And they're not therefore useful for the ongoing management of risk in a dynamic environment such as what we all live in. So at the Insurance Development Forum, we have a whole program of work around opening up data and opening up the models that underlie many of these analyses used for climate risk insurance. Now, the benefits of this that we see, and many agree with us on this, is of course that understanding risk is absolutely critical for management of events and natural disasters. And as I said earlier, insurance, climate risk insurance is just one piece of the total suite of solutions that need to be brought together to plan and adapt to climate change. So these models and this data can also be used for quantifying the benefit of investment in adaptation mechanisms. It can be used to determine disaster risk financing mechanisms, and it can also be used for delivering metrics for the risk transfer that can be understood on all sides. And it's really important that we get to a point where all sides of the transaction have a common understanding of the risk, and in the information about the risk and the understanding of the risk is not limited to one side of that transaction. So we promote open source risk data modeling to democratize that risk insight by the owners of the risk itself. So they could be governments, it could be local governments, it could be civil society, it could be public sector decision makers. It is also the private market. And we want to increase the transparency of data and assumptions and models for all stakeholders, and improve the understanding of uncertainty associated with these models as well. We want to share data and models throughout the community to reduce that redundant and repetitive work that I mentioned earlier, to increase efficiency and reduce costs for everybody. Data and modeling is expensive, so we believe that as much sharing as possible is required to reduce the costs of the risk understanding, which will then lead to reduced costs in effective mechanisms as well. And we've also believe and know that collaboration partnership brings local knowledge into the system, and it helps redress this balance of risk understanding, which can unfortunately be today more on one side than the other. So we're running some projects which are using the OASIS open source loss modeling platform. OASIS is a not-for-profit organization. It's funded by the insurance industry and public sector. It's available worldwide. It is a modeling framework that provides a calculation engine into which hazard, vulnerability, exposure, the type of data I described earlier, are plugged into it. And you can calculate the probabilistic risk and loss metrics for risk pricing and capital management that are required for the risk understanding and the risk pricing. It is free to use by anyone, and it's downloadable from the from GitHub, which is the global repository of open source software, for free by anybody to use. And we are doing some projects, for example, this one in the Philippines and also in Bangladesh, funded by the German government, where we're bringing together public-private partnerships to get the data and build risk models for flooding and including climate change across these countries, and provide those models at the end of the day on the OASIS platform. We're working with local academics and agencies in the countries to embed their local knowledge into the data and into the modeling and into the system. We are, through the project and through their involvement, improving the in-country understanding of risk, improving their conversation, the conversation between the country and the international finance markets. And one major goal is to create end user ownership and long-term sustainability in the country of the data and the modeling to understand and manage the risk on an ongoing basis from within the countries themselves. And I want to end with one final example of how this type of risk modeling, whilst of course it's critical for climate risk insurance, it's also useful for other purposes, such as the holistic view of economics of climate change adaptation. So this study was released last year. It's a case study for San Salvador. And using the OASIS loss modeling engine and doing some flood modeling, we can see that there's a projection of expected annual losses due to flooding to change between 2015 and 2014, that we expect that the combination of economic development and climate change could more than double annual expected damages. This is without any intervention at all. We could expect this. We can then identify, using this modeling system, that we can prevent more than $27 million of that potential loss by implementing just 2 of the most cost-effective physical adaptation measures. And these are actually adapting residential houses to withstand flooding. We can actually save some of that potential loss. So without the adaptation measures, we see the figure on the left-hand side, but with adaptation measures, the expected losses can be reduced by 25%. And if implemented, we would expect that insurance premiums could be reduced by 35% compared to the situation without these adaptation measures. And of course, an important component of risk insurance is this price signal it sends about risk. And if risk is reduced, then the pricing and the cost of cover for that risk should also reduce. So in fact, we can reduce potential losses by putting in physical adaptation measures, and through that also reduce the potential future cost of risk insurance to cover those exposures. So hopefully that gives an overview of the type of risk insurance, climate risk insurance mechanisms that are available, the types of data that are required to understand the risk and to put in place these types of mechanisms and to enact risk transfer. And it gives you some examples of how that data and modeling can be used for other purposes. And we've given some examples of some of the challenges with the data and the models, and how we hope to overcome them through more open data sharing and open modeling that we know and we have increasing evidence will benefit everybody in improving efficiencies and reducing costs overall. So with that, I shall finish my presentation and I shall hand over to Stefan Eppert, and I look forward to receiving your questions later. Thank you very much.
Hello again, everyone. This is Katharine. I'd like to take this opportunity while Stefan is preparing to share his screen to introduce him and to introduce KatRisk. So you've already seen KatRisk mentioned on one of Claire's slides where she talked about the partners who are working with the IDF and others on the OASIS project. KatRisk is a catastrophe modeling company that was founded in 2012, and it aims to be a provider of comprehensive and cost-effective catastrophe risk models and data that can bring exceptional value to clients. Stefan himself is Managing Director at KatRisk and has worked for 6.5 years at Risk Management Solutions on the development of continental flood risk models, model implementation and simulation methodologies. Stefan, thank you so much for making yourself available this morning. We're very much looking forward to hearing from you. And just a reminder to our participants, if you want to start posting any questions, please use the Q&A box that you have available to you. And we will certainly allow some time to address those once Stefan has finished his presentation. Over to you, Stefan.
Yes, thank you very much, Katharine. Let me try to share the screen because this didn't work before. So, can you see my slides?
We can't yet see your slides.
Let me. So, for some reason, I can't share my screen yet. Okay, well, I'm trying to. Here it is. No. So sorry for this.
We can see them now, Stefan.
That's great. So let me go to full screen. So thanks everybody for listening. Thanks Katharine for the introduction, and thanks Claire for laying the groundwork and giving a good overview of CAT modeling. As Katharine said, we are building global models for atmospheric perils like hurricanes and floods. Our main customers are insurance companies, reinsurers, brokers, and the like. But we also work with state actors like FEMA in the US, the Federal Emergency Agency, and are now involved with OASIS in the aforementioned ICI project, a flood model for the Philippines, with project partners locally like NetRe and Pagasa and UP Dream. We are also currently in the initial phases of working with the GIZ for the RFPI Asia program, which, same as the ICI project, aims to develop access to the global insurance market for risks or risk takers in Asian countries. Why is that important? As you all know, insurance is based on risk sharing, but it's also based on the assumption that not a lot of people in the insurance scheme get it at the same time. Otherwise, premiums just become so high that it doesn't make much sense anymore to share the risk. And this is where catastrophes are problematic compared to other problems like car accidents or normal accidents in houses, fires, and the like. So if you run a local scheme, especially for microinsurance, if you are at risk of exposing a lot of your customers to a catastrophe at the same time, then ideally you want to share some of the risk with outside parties who are insuring globally and therefore can diversify their risk and keep premiums low. So even if you have microinsurance in place, it's good to have access to global insurance companies which can help you over these large-scale events. To get insurers on board, they need to be able to price the risk, and for that, if they don't have local data, they use CAT models, catastrophe models. The typical questions they ask, how much premium should I charge to each person I reinsure? But also, how much capital do I need to retain in case some big catastrophes happen, so that I can still pay out and don't go bankrupt myself. And then finally, there's the more strategic questions. Where should I be writing new business in a way that it is uncorrelated to the risks that I'm currently insuring? So ideally, insurers want to share the risk again globally, so that not all regions or large fractions of their insured are being affected at the same time. So for that, as Claire said, they use CAT models. The reason for that is that historical data often is insufficient, because by definition, extreme events are rare. But also for events that happened a few years ago or decades ago, typically there's not much data available. We have changes in population, in buildings, in flood defenses, land use changes, climate changes. So it's very hard to make use of, say, old data, even if it is available. So what we do when we build a CAT model is that we create lots and lots of synthetic or artificial events. An event being, for example, a tropical cyclone hitting the Philippines or part of the Philippines, but it could also be a flood or an earthquake or something like that. So we generate tens of thousands of events which have not happened, but which might happen. And each of these events has got a probability. So we try to keep the statistics that are observed in real events, but slightly perturb them so that an hurricane, say, maybe goes a bit south of where the observed hurricanes went, or gets a bit stronger, or the track is slightly shifted. And from these events, we calculate losses based on the exposure that people insure. So whether you're a microinsurance scheme or a global insurance company, you can put in a list of all the people who have written policies with you, where they are, what kind of houses they have. And then based on the vulnerability data that Claire mentioned, we calculate what an expected loss is given that you experience, say, a 50-mile wind speed or 1 meter of flooding. And from all these data points, we construct so-called EP curves, exceedance probability curves, which give you the probability of exceeding a loss in a given year. So what's the chance of having a tropical cyclone that causes more than $100 million? Or how often do I have to pay, say, more money than my bank is willing to give me? Or how much do I need to pay if I want to be able to pay out losses which occur once in 100 years? And of course, one of the most important questions is how much do I lose on average, which is roughly how much each insured should pay. Now, if we want to build a model, we start with modeling the hazard. The hazard being the physical phenomenon that causes loss. And I've here got the schematic for the flood models that we're building for the Philippines. There we want to predict inundation depth. So how high does the water pond up at each place that is affected? And to start with that, on the left, we start with a global sea surface temperature model, which simulates the Earth, the ocean state, the temperature anomalies, that captures effects like El Nino and La Nina, Atlantic multi-decadal oscillation, and other teleconnections which affect the global climate and affect where in a given year these heat tracks are likely to occur, how rainfall patterns are going to shift, what temperature anomalies we see over land. Driven by these sea surface temperatures, we model both precipitation patterns and the tropical cyclones themselves. The tropical cyclones also come with precipitation. And for some models, we also look at the wind fields and the storm surge that are caused by those fields. So these models can get more and more complex. Then once we have the precipitation, we have got small catchments on land, small areas where we calculate the hydrology. That means we look how much precipitation occurs every 6 hours, how much of that evaporates, how much of that goes into the soil, how much becomes runoff. The runoff goes into the rivers. Then we see where does it flow, how do the rivers, river confluences affect the discharge downstream. And then finally, after checking for defenses like levees and dikes which are in place, whether they are overtopped, whether they break, we have got fluvial inundation, and that then gives us the spatial patterns of an event. So there's a lot of computation, a lot of science that goes into these models. When we build a model, we typically spend years collecting data, fitting models, running models, and then creating tens of thousands of years of unobserved weather, which contains these extreme events. So as Claire said, we need a lot of data. In general, I would say the data quality in the Philippines is very high for everything that you can gather now. So say terrain data. You fit a scanner to a plane and fly over the landscape and record the changes in elevation and to a very high resolution. And there the data quality, I would say, is about on par with what we get in Europe. Historical data is often more difficult, and data availability can be challenging. These problems also occur in Europe. The US there is really the beacon of light, which has got a very free access policy. But yeah, for a lot of things, I would say the problems that we face in building models for emerging countries are not so much that data isn't there, but that access is just difficult and bureaucracy. So yeah, in theory, we are very well placed to build these models. Often the market forces aren't there, so it's very good that we have players like GIZ and ICI, which support the development of these products. And then we will I think within the next few years, see quite a comprehensive coverage of risk models for developing countries. Final point I'd like to touch on, and I try to keep this brief, is that traditionally models have been quite static. The users upload their exposed locations and then get a number back. And also the users have more or less exclusively been insurance users with very similar demands. We now have a wider group of stakeholders which would like to use it, and also different sectors of the market with different needs. So what we are working on in these projects is to really make these models more accessible to the user and more adaptable by the user. And that means feeding in your own data, feeding in data which maybe cannot be shared due to legal restrictions or for competitive advantage or for cost reasons, so that agencies can feed in their data, say microinsurance schemes which have got very specific needs in terms of vulnerability modeling can feed in their data, and also new data can be fed in if the system changes, if defenses change, or if we have new ideas on how climate change is developing. So I think in these regards, the models are becoming more useful, and I would encourage everybody to how you can use those your own requirements within a changing climate. And with that, I would like to give the room for questions. Thank you.
Thank you, Stefan. Can you hear me?
I can.
Thank you, great. I'd just like to pick up on something that you've alluded to and Claire has also alluded to, which is these models have been developed primarily for insurance purposes with a view to being able to price risk and therefore provide adapted insurance solutions. But they can, of course, be used for other purposes. So I wonder if each of you could just take a couple of minutes to talk about those other uses in terms of decision making for urban planning, possibly for building codes, and so on.
Yeah, Claire, do you want to start?
Sure, yes. Yeah, let me start, and I'm sure you've got some examples to add as well, Stefan. Yes, so because these models are quite physically based, they can be used for a wide variety of other decisions, as you just said. So, and they're also computer-based simulations, so relatively rapidly we can use the models to test the impact of different interventions, for example. So that's one set of examples is for doing things like urban planning. So you could simulate in your model framework through time development of an urban area, and you can look at how that intersects with the risk from whatever type of source that you're interested about. So, for example, flooding. So you can visualize the flood risk in terms of a flood risk map, and you can overlay that with different scenarios of how an urban area might develop, for example. And then you can also simulate bringing into that the potential impact of mechanisms such as flood defenses, or for individual properties, even putting in individual property protection mechanisms. And that could be localized flood defenses, it could be mechanisms such as raising up the entrance to the house by a certain level, and you can decide what level that should be to protect against what level of risk. For example, a 100-year flood event or a 20-year flood event, you can calculate what sort of flood heights you might experience at these different type of return periods, and then decide, should we raise up entrances to that level? interior of properties. You could get some very, very detailed models where you can look at really a lot of different types of adaptation mechanisms within properties. Now, of course, all of that comes with increasing data requirements, but you can see you can go from large scale modeling for a whole area down to very individual property modeling. And you can also look at the impact of flood defenses on the area, again at a very local scale or a regional scale. You can, because we can calculate economic impact, we can, as I showed in the example, calculate the saved losses that can occur from these mechanisms and compare that to the cost of putting them in place. So that's a whole suite of climate change adaptation decisions that you can use for these models. Yes, you can also use them for building code design, again, because we can quantify risk at different, or quantify the hazard at different levels, different return periods, and then that can be used by decision makers to decide what level they want to protect to. And again, you can run simulations. As I talked about with the exposure module, you can plug in different exposures which may be more or less vulnerable than what actually exists, and you can see and quantify relatively quickly what the impact on the overall risk profile would be. So there are two examples. Stefan, do you have any others?
One other example would be real-time response, and I'll try to keep this short. So if, say, Pagasa has got projections for a tropical cyclone coming into an area, these models can be used to quickly translate wind speeds, number of people, and then you can, ahead of the event, already make plans. How many people may you need to bring in from other areas to take care of the people who are affected, to repair buildings, maybe to pay out microinsurance schemes, and you can do some planning ahead of time to just make processes run smoothly after a catastrophe.
Annette Detken, who is one of our participants and is also along with me on the operating committee of the IDF, would like to add to Claire's answer. If we could hand over if we could unmute Annette so that she can contribute to that answer on behalf of ISF. Hi, Annette.
Can you hear me? Hello.
Very well.
Thank you very much. This is Annette Detken. I'm head of the Inter-Resilient Solutions Fund, and thank you very much, Claire, for also including our joint case study on El Salvador in your presentation. And there's not much to add because after I posed my question, Claire also pointed out very clearly that these risk analyses that can be actually conducted with the risk models that were presented here are a very helpful instrument for policymakers in order to prioritize different options on climate adaptation. As Claire pointed out, for example, in El Salvador, we could really then show which kind of measures will reduce risks to which extent. And so that is prioritizing different adaptation measures and risk mitigation. But then also this really defines what are the remaining risks and where actually has insurance a relevance in managing these risks. So this was just to maybe say that for the implementation of policies in the national determined contributions and national adaptation plans, these risk models can really be very helpful. Thank you.
Thank you, Annette. Claire, we have one final question, and we have to wrap up very soon. From Antonis Malagares, my colleague at GIZ RFPI in the Philippines. And Antonis would like to know, bearing in mind that what we're looking at in this series of webinars is building resilience through climate risk insurance for MSMEs. He's raised the point of affordability. And the concern that even where localized data and good quality data is available and validated, the premium risk might still be as high as 20%. How can one overcome that in terms of making the insurance still affordable for households and very small businesses at the lower income end of the scale, for example, in the event of a flood?
Yeah. Well, yes, it's a very pertinent topic and question.
And obviously, you only have 30 seconds to answer.
Yeah. Well, I'm afraid don't think I'm the right person to answer this question. My expertise is on risk data and modeling, and not on risk, not on insurance mechanisms. I think there is a big conversation to be had on this, which will probably take more than 30 seconds because of the discussion that needs to be had, which is much more about the mechanism itself that's set up, who pays for it, is it a risk-based scheme or not? Then there need to be some conscious decisions made about that, and the risks of doing that as well. Of course, if schemes are not risk-based and risk-priced, then there is risk associated with that, of course. Schemes may be vulnerable to becoming bankrupt, for example, if you have a very, very, very big event. So there need to be mechanisms put in place around that as well. So I think the issue of premium affordability is a big one, and possibly there is another session coming up that may specifically touch on that.
Great, thanks, Claire. Stefan, I'd like to ask you, as we wrap up this webinar, if you could just comment on or wrap up by saying the three things that you think really need to happen to move this forward quickly, which is clearly very necessary.
Yes. So first of all, I would hope that we can, in a short time frame, bring the tool set that we have for developed markets into the developing markets, insurance markets, maybe thereby lower the risk loading in the premiums. I would hope that we can increase coverage tremendously, that poorer participants get access to the risk transfer that we all benefit from in the developed markets. Yeah, and I would hope that we can all meet in person next year again once the health crisis is over.
Great. And Claire, I'd like to ask you the same question for your wish list.
I think my wish list is for sharing data and information. Similar to Stefan, it's about embedding the knowledge in countries and with risk owners. I think risk owners need to understand their risk, not just the providers of solutions to risk, which is more the case today. So my calls would always all be about dialogue, communication, partnership, working together, and understanding and sharing of the data that underlies all of these decisions.
Great. I'd like to thank you both very much, and also our participants and our three teams, White Pioneer, GIZ in the Philippines, and my team here in Luxembourg. We're all, like most of you, or all of you who have participated, and a warm thanks for your interest. I think most of us are working from home, so I'm pleased that we could have this carrying on and going forwards. I'd like to remind everyone that we have two further webinars tomorrow. The first one on developing insurance for MSMEs specifically, looking at some of the existing solutions and what is needed. That will be taking place at 4 o'clock in the afternoon Manila time, so 9 o'clock European time. And then the final session of the webinars immediately after we'll look at micro versus meso versus macro insurance solutions. Are regulators ready? And that will be taking place from 5 o'clock Manila time, and so 10 o'clock European time. And that will be moderated by Hannah Grant, who's well known to most of you, I think. And the previous session will be moderated by Lorenzo Chan of Pioneer, and also board member and treasurer of Microinsurance Network and a trustee of MEFIN. So with that, thank you very much. A reminder also that these recordings will be available on our website. And thank you for participating today. Bon courage to all of you, and stay well. Thank you.